You signed a loan a few years ago, and the terms felt perfectly fine at the time. But things change over the years. Interest rates move, your income grows, and your credit slowly improves. The loan you are carrying today might not be the best loan available to someone in your position now. Refinancing is the process of replacing an old loan with a new one, and understanding how it works can quietly save you a meaningful amount of money. Refinancing simply means taking out a new loan in order to pay off an existing loan. The new loan replaces the old one entirely. You still owe money, but now you owe it under a different set of terms. Those terms might include a lower interest rate, a longer or shorter repayment period, or a different monthly payment. The debt itself does not disappear in any way. It just gets restructured into a new shape. This matters because the terms of a loan quietly decide its true, total cost. Two people can borrow the exact same amount of money and pay back wildly different totals, simply because of their interest rate and the length of the loan. If your situation has genuinely improved since you first borrowed, you may be paying far more than you actually need to. Refinancing is the tool that finally lets you correct that. Here is how the process actually works. You apply for a new loan, often from a completely different lender. They review your credit, your income, and the value of any collateral involved. If they approve you, the new lender pays off your old loan directly, on your behalf. From that day forward, you simply make your payments to the new lender under the new terms. The old loan is closed, and a fresh one begins. Imagine you have a car loan at a fairly high interest rate, because your credit was thin and untested when you first bought the car. 2 years later, your credit has steadily improved. You decide to refinance into a new loan with a noticeably lower rate. Your monthly payment drops, which feels good, but the bigger win is quieter. More of every single payment now goes toward the actual balance instead of interest. The most common mistake is focusing only on the monthly payment. A lower monthly payment feels like an obvious win, but it can quietly hide a much longer loan term. If you stretch a loan out over more years, you may pay less each month while paying far more in total interest over the life of the loan. The monthly number is not really the goal. The total cost is the thing that matters. There is also a hidden cost to refinancing, which is the closing costs and the fees. Refinancing is not always free, even when it feels like a simple swap. There can be application fees, origination fees, or other charges quietly built into the new loan. If those costs are large enough, they can completely cancel out the savings you expected from a lower rate. You always have to compare the savings against the cost of getting them. Think of refinancing like swapping a heavy backpack for a lighter one in the middle of a long hike. The destination is exactly the same, and you still have to carry weight either way. But if the new pack fits your shoulders better and weighs noticeably less, the rest of the journey becomes genuinely easier. Just make sure the swap itself does not cost you more time and energy than it actually saves. Here is a second key idea, the break-even point. To know whether refinancing is truly worth it, you compare the upfront cost of refinancing against the monthly savings it gives you. Divide the total cost by the monthly savings, and you get the number of months it takes to break even. If you plan to keep the loan well past that point, refinancing usually makes solid sense. Say refinancing costs you $600 in total fees, and it lowers your monthly payment by $50. 600 divided by 50 is 12. So it takes 12 months of payments just to break even on the cost. If you plan to keep the loan for several more years beyond that, then every dollar of savings after month 12 is real money landing back in your pocket. Beginners often think refinancing resets nothing except the interest rate. In reality, it very often resets the clock as well. If you refinance a loan that had 3 years left into a brand new 5-year loan, you have quietly added 2 more years of payments. The rate may be lower, which feels good, but the longer timeline can still increase what you pay overall. Always look carefully at where the new finish line sits. There is a real emotional pull here too. A lower monthly payment feels like genuine relief, and relief is always tempting in the moment. But relief and savings are simply not the same thing. Some people refinance again and again, quietly chasing that lighter monthly feeling, while their total debt timeline keeps stretching further out. That calm, comforting feeling can slowly lead you away from actually being free of the debt. A practical rule is to refinance in order to improve the loan, not simply to escape the payment. Ask yourself one honest question. Does the new loan lower my total cost, or shorten my path to zero? If it does either of those, it is a genuine improvement worth pursuing. If it only lowers the monthly number while quietly extending the term, pause and look much closer before you sign anything. Avoid refinancing right before a major application, like a mortgage, because new loans can affect your credit temporarily. Avoid rolling extra cash or other unrelated debts into the new loan without thinking it through very carefully first. And avoid any lender who will not clearly show you the full cost, the rate, the term, and every single fee, all written down plainly in front of you. A better habit is to review all of your loans once a year. Look at the interest rate, the remaining balance, and how the wider market has changed since you borrowed. You do not have to take action every single time you check. You are simply staying aware of your options. Most people refinance far too late, or never at all, because they quietly forget the loan even exists. A yearly check keeps the option alive. Over the long term, smart refinancing can shorten your debts and steadily reduce the total interest you pay across your whole life. But careless refinancing can quietly do the exact opposite, slowly extending you into a near-permanent state of borrowing. The tool itself is completely neutral. The outcome depends entirely on whether you choose to measure the total cost, or simply keep chasing a smaller monthly bill. So here is the short version. Refinancing replaces an old loan with a new one under different terms. It can lower your rate, change your timeline, or adjust your payment up or down. It is genuinely worth it when the savings clearly beat the costs, and when the new term does not quietly stretch your debt out further. Always compare the full total, not just the monthly number. Refinancing is not a trick, and it is not a magic shortcut. It is simply a chance to renegotiate the weight you are already carrying. Used with clear, honest eyes, it can make a debt both cheaper and shorter. Used carelessly, it can quietly make a debt last almost forever. Know your break-even point, watch the finish line closely, and let the math, not the relief, make the final decision.